Hello, this is problem 27 of chapter 1, and this problem continues some of the concepts with starting with an investment with a fair value security and then changing it to an equity method security later on after influence is acquired. The thing that makes this one a little bit harder than problem 126 is that we purchase our shares of the security during the middle of the year. So the first purchase of 5% purchases Barker's 5% of outstanding stock October 1st. So you have to figure out, well, what is the book value of Barker's interest in Smith as of October 1st between January and the end of September. We have 3/4 of a year of income, 20,000 of income, less 8,000 in dividends. So the increase in net assets or the increase in equity would be 20,000 less 8,000 for a full year. 3/4 of the year is 9,000. So the book value of Barker is 109,000 on October 1st, 2011. We acquired 5%. If we acquired it for its book value, it should have been $5,450. However, we paid more. We paid $7,475. So the reason we did is we saw some intangible assets. We said that these are all intangible assets that are amortizable. It doesn't always have to be amortizable. This is over 15 years. It's $135 a year. So we buy 5% of Barker. We pay more than its book value at the date of acquisition. Again, the date of acquisition is in October 1st, so it's not during the beginning of the year as the prior problem. We assume that we paid $2,025 extra for an asset that will have value and wear out over the next 15 years. Annual amortization for the first purchase is $135. The second purchase is for $14,900. We get another 10%. So after the July 1st, 2012 purchase, we'll own 15%. But it's still not enough. So we have to figure out how much the book value is on July 1st, 2012. We have the book value on January 1st, 2011, add net income from 2011 of $20,000 for the full year, dividends, subtract the dividends, 2011 for the full year. So the equity would have increased from $100,000 to $112,000 by the difference between net income and dividends. During the next year, for the first half of the year, before July 1st, equity increased by half of the income minus half of the dividends. 30,000 income for the year minus 16,000 dividends for the full year is 14,000. However, we only have it for half a year prior to the acquisition. So what we're going to see is that we will assume that the book value, the day we acquired it, only had gone up by a net of 7,000. The book value of Barker, the second purchase date was 119,000. We purchased 10% more. 119,000 times 10% would be 11,900. Obviously, we paid 3,000 more than the book value. It is not uncommon to pay more than book value. We think that there's some intangible assets that have a remaining life of 15 years. So each year would have excess annual amortization because we paid above book value for $200. So the initial 5% has annual amortization of $135 a year. The second 10% would have annual amortization for every full year we own it of $200,000. Finally, December 31st, 2013, we purchased enough to give us influence. So we purchased a final 20%. Now we own 35%. At the beginning of 2013, okay, in 2012, the beginning of the year, the book value was $112,000. We had $30,000 in net income from 2012, minus a full year of dividends. So that would give us $126,000 at the beginning of 1/1/13. We buy this, the equity increase during that year for a full year, $24,000 net income minus $9,000 in dividends. So equity increased by $15,000. Altogether, book value of Barker on December 31st, 2013 is $141,000. 20% of $141,000 would give us $28,200. We paid $34,200. We attribute this excess intangible assets that will have a life of 15 years. So, with respect to the third purchase of the final 20%, we have $400 in excess amortization a year. So, let's look at what happens for equity income in 2011. We would accrue 1/4 of net income. So, net income for a quarter of a year times 5%. The amortization, we said it was $135 for each full year you own it, but we only own that 5% for a quarter of a year. We bought it on October 1st, 2011. Equity income for 2011, net of any excess amortization for the fair value above book value, leaves us with $216.25. For 2012, well, we have an accrual, $30,000, the first purchase for the entire year. So 5% of the $30,000 in net income applies to the 5% we own the full year. The second purchase, we owned half year, and the second purchase was an additional 10%. So 5% of the $30,000 in net income, we're entitled to that because we own the 5% initial interest for a full year. Another 10% we owned half year. We amortize the excess amortization, the excess we paid for the first purchase over the full year because we owned the first 5% for the full year. The other 10% we only owned for half a year from July 1st on. So we have 5% owned a full year, 10% owned half a year, amortization, 1 whole year of amortization on the first 5% we bought, half year amortization on the second 10% we bought. So the total equity income is $2,765. So for 2013, we know that we've owned 15% for the entire year. The basic equity accrual, 24% or $24,000 times 15% of the year. The other 20% that we purchased was on the last day of the year. We have, for the 5% purchase, excess amortization of $135. For the 10% purchase, excess amortization of $200,000. So the equity income we would report, we own 15% of it a full year. Amortization on the first purchase, $5,000, or sorry, 5% is $135. Amortization on the second purchase, 10% is $200. Equity income would be $3,265. So altogether, the cost of the first purchase is $7,475. The cost of the second purchase, $14,900. The cost of the third purchase, the final 20% that we bought at the end of 2013, is $34,200. Equity income, 2011, we only had a quarter of a year for only 5%, less excess amortization for a quarter of a year. 2012, we owned the 5% stake all year, the 10% stake addition half a year. In 2013, we had 15% for a whole year, and we acquired the final 20% on the last day. We would subtract the dividends. The dividends would reduce the investment in Barker. A quarter of the dividends for the 5%, a quarter of a year, 5% interest owned. So we had quarter of a year's worth of dividends. We only owned 5% of those dividends of $8,000. We'd have 5% of the $16,000 amount of dividends. And the second purchase, where we owned 10% of the company in addition to the first 5%, was only for half a year. Finally, we owned 15% of the shares for a full year in 2013. We don't get any dividends for buying the last day of the year. We don't get any dividends for buying the extra 20%, the final 20% interest, the last day of 2013. So altogether, we'd have equity income making the investment go up. Dividends would reduce the investment. Okay, so what more can they ask us? Not much. The good news is that your homework for problem 24 and 25 is a little less detailed. I thought it would be more important to go over more difficult problems. So good luck, and please try it.